Good afternoon, everyone. Thank you for joining us today in this first breakout session. I'll introduce myself briefly at the top, as well as the topic, which is best practice and current trends in event-driven risk management. My name is Joshua O'Mara. I work at Deutsche Bank and have been at Deutsche Bank for a bit over 11 years now, working in both sales and in structuring within the foreign exchange department at DB. During my time at DB, for the vast majority of it, I've been focused on event-driven risk management as a specialty. In the last year, I've been asked to take responsibility for our UK and Ireland corporate FX coverage team, as well as our EMEA-based financial sponsors coverage efforts. But I retain a lot of interaction with clients on event-driven risk management, generally speaking, and it's one of the parts of my job that I love. So I hope I can convey to you some information today which proves to be useful in the context of your roles within the companies that you work for. I should state up front that in terms of objectives, mine are to do a few things. First, to go through the fundamentals of what we consider to be best practice. That's based on years of experience working with clients on hundreds of transactions and taking into account their views in the aggregate on best practice. And not every deal is the same, but there are some common threads in terms of client objectives that we've observed over the years. Secondly, for those of you who may be very familiar with this topic, where the first part of the presentation is more of a refresher, we also want to go into some recent innovations in the market, things that you may not have heard about previously, or where you've only got sort of a cursory amount of information, and give you a little bit more to think through. This session will go 40 minutes in total. I'm going to leave approximately 5 to 10 minutes for questions at the end. I believe you'll have the opportunity during the midst of the presentation to submit your questions. I'll be able to see them, so I'll have a sense of the topics that you're interested in and how many questions there are. That will help me gauge how much time to leave at the end to answer your questions. And then lastly, these sessions are meant to be high level, but we find it is most useful to interact with clients on a one-on-one basis. And so at the end, I'll just provide some information on how to follow up. We find that sessions with individual clients on best practices in the context of their own organizations, their own objectives, and generally outside the context of a live transaction are best received. These are, we get a lot of very positive feedback on these sessions. And so I encourage you, if you do have anything at all that you'd like to follow up on, whether it's to go through this entire presentation again in much more detail with an eye on your specific concerns and objectives, or to drill down on any one piece of information, please feel free to reach out to me. I believe my contact information is on the speaker bio page for the conference. I'll just state up front, you can also reach me at Joshua, Joshua, .O'Mara, O-M-A-R-A, @db.com. Just say that one more time, Joshua, .O'Mara @db.com. With that, let's dive into the materials. So what we want to do is talk about a distinct topic within foreign exchange risk management that has some common elements with managing foreign exchange risk generally within your business, which I'm sure you and your colleagues do on a day-to-day basis, but where there are enough distinct features that it lends itself to a presentation like this one to go through the important differences. In general, M&A transactions, which are the bulk of the transactions we work on from time to time, we'll also see capital markets transactions or project finance oriented transactions, but in general, the bulk of the deals that we're working on and where this framework applies are in M&A transactions. They tend to be oftentimes quite large. They tend to have a lot of both internal and external scrutiny, which sometimes plays a role in terms of the level of conservatism with which our clients choose to manage these risks. Third, and probably most importantly, there's a contingent element to the risk. Specifically, there are, generally speaking, conditions to close contained within the contract which binds buyer and seller to close the deal. And where if those conditions aren't met, or where a limited number of termination rights are met, the transaction will go through, unless a condition to close is not met or a termination right is triggered. And so that contingent nature and the fact that these contingencies are generally third-party contingencies is a unique factor which plays on the nature of the risk and how we see our clients generally managing those exposures. If I flip for a moment to the first page, what I want to convey here is that in the context of an M&A transaction with a market exposure, whether it's an FX exposure, a rates exposure, commodities pricing exposure, inflation exposure, what have you, whatever market it may be, you're really talking about two distinct risks, which sometimes interact, but more often than not are fairly independent of one another. And over time, the quantum of these risks varies in their nature. So on the M&A side, we're typically talking in the context of a M&A transaction, conditions to close that revolve around things like valuation. Will the target shareholders, if it's a public company deal, approve the deal? Are they happy with that valuation? Two, is there any interloper risk? In most jurisdictions on public company takeouts, at least, there's a fiduciary obligation on the part of the board of the target to entertain superior bids, is oftentimes the legal terminology that's used, but essentially a higher offer for the company. And so that question of interloper risk often plays a role on public company transactions in assessing and quantifying the risk around the M&A transaction. And generally, you'll also find regulatory approvals. Again, another third-party approval that is required. These vary from antitrust, which is present on most deals, the need to get an antitrust approval from one or more regulators. Secondly, industry regulators. You might have a health regulator, health and safety regulator. You may have a communications regulator, various types of industry regulators who need to approve transactions, banking regulators. And then finally, and this is an area where there's an evolution going on at the moment, in many jurisdictions, including the UK, there are foreign direct investment regulatory approvals. CFIUS is a very common one in the US, well known. At the moment, there's legislation in the UK around the UK's own FDI regulations and how that will impact deals going forward. So this is an evolving area of risk. It's never static, and it's one where you have to pay a lot of attention in terms of thinking through the quantum of this risk and the nature of the risk in assessing whether and how you manage the market risk associated with it. Market risk is the second piece. And obviously, market risk varies across time. This is also not a static risk. We've seen periods where implied levels of volatility in the foreign exchange market, for example, have been very muted and kind of consistently so for long periods of time. And then we've seen, for example, last year with COVID, periods of unexpected and sustained increases in volatility. So while this particular risk is one that changes, the good news is the pricing for the kinds of hedges that we'll talk about in a moment is very much tied to levels of implied volatility. What you'll hear in a moment is best practice in M&A-driven risk management is generally through the use of uncommitted forms of hedging. I'll come to that in a few moments. But there are basically two: purchased options and deal contingent forms of hedging. And I'll, again, go through the characteristics in a moment. But the elements that affect these two forms of hedging in terms of pricing are directly tied to levels of implied volatility. Implied volatility drives option pricing, and the price of options is basically used as a benchmark for pricing deal contingent forms of hedging. So in periods of higher volatility where the market risk is greater, you'll pay more for the hedge. In periods of lower volatility where there's still risk, but it's more muted, you'll pay less for the hedge. And in general, the good news is that pricing has become more favorable regardless of what's happening to levels of market volatility for clients who are looking at M&A driven risk management, largely because this is a competitive environment and banks want to get into this, this part of the market in terms of providing services to clients. There are some cautionary tales, which I'll get to in a moment, but I just do want to touch on why we consider uncommitted forms of hedging to be best practice. And I'll pose it in the opposite way. Why are committed forms of hedging considered not best practice? So let me first define terms for a moment. A committed form of hedging is going to be very familiar. It's an outright purchase of a currency that has no conditionality associated with it. You might buy the currency outright and put it into an account. So for example, if you're a UK corporate, you're buying an asset in the United States, you're going to finance it with sterling denominated sources, but pay a dollar denominated purchase price. You can go buy dollars outright in the spot market, put the dollars in escrow or an account and hold them. Alternatively, you can enter into a vanilla forward contract for the purchase of those dollars 6 months or 9 months down the road, whatever the relevant timetable is. The use of committed forms of hedging, like purchased FX forwards, is a committed form of hedging, and it's not considered best practice because while it does hedge you against an unwanted market movement, in the example I gave, sterling depreciated against the dollar, there is an uncapped potential loss or gain, but from a risk standpoint, the concern is an uncapped potential loss in the unlikely event, but still possible event, that the M&A transaction fails to close for any reason whatsoever. And the cautionary tales that we have on the following page, which I'll flip to in just a moment, are some examples of, I guess, very bad days on the part of the management team of the companies shown on this page. And not meaning to pick on these companies, there are plenty of examples, but the disclosure for these particular situations was particularly robust, and so we included them here. It's a bad day for a public company, or any company for that matter, when an acquisition or divestiture that was previously announced fails to close. Generally speaking, especially for larger deals, these are significantly socialized in the public domain. There are oftentimes impacts in terms of how the company progresses during the period between announcement and when it expects the deal to close. So companies tend to be very focused on getting acquisitions or divestitures across the finish line. Investors have an expectation that those deals will close, and the management team's attention on these transactions is going to be worth it. So if you have to announce that a deal that you've been spending months on is not closing, that's a bad day in and of itself. To compound that, though, with having to announce that you've got a very large loss on a derivative associated with that M&A transaction is the kind of thing that can obviously prove to be very problematic for management teams. And so these are basically cautionary tales. I think while we do see it from time to time, clients using vanilla products, vanilla forwards, committed forms of hedging to manage M&A driven market risk, it's not the most common approach that we see. And when we are working with clients, and that's the route they go down, we make sure that they understand the risks and that those risks have been socialized amongst the senior stakeholders within that firm. So if I move on then, we'll go to the next page, which is really the framework itself. And this applies across the board, regardless of what the underlying product is, whether it's FX or rates. The way we think about things is, especially in an M&A context where there's a lot of focus and attention internally at our clients, all the way up generally to the C-suite, attention amongst investors, whether they're debt or equity investors, rating agencies, et cetera, we want to take a very thorough approach. And so first, we describe and quantify the risk. in partnership with the clients that we're working with. Secondly, we want to understand what client objectives are. And there are some common objectives, that most clients want to have a low cost or as low a cost as possible for hedging. But beyond that, there are other objectives which vary from client to client around things like accounting considerations versus economic exposures, whether they are seeking participation in favorable moves while also protecting themselves from a downside move. There are a number of bespoke objectives that we've come across on one deal or another. Third, to present a variety of solutions, compare and contrast them, and help the client socialize internally the information such that a decision can be made. Fourth, execution of that hedge in a way that hopefully is not disruptive to the underlying market. Most clients want to not have a big footprint in the market when they're executing their hedge. And finally, monitoring the hedge over the life of the transaction. We do see from time to time hedges get restructured as the underlying deal progresses. The level of certainty on the underlying transaction does evolve over the life of an M&A transaction, and sometimes clients choose to restructure their hedges accordingly. Again, best practice in the context of M&A, based on what I've just gone through, is through the use of uncommitted forms of hedging. Again, there are two basic types: purchased FX options and deal contingent forms of hedging. What are the common elements? First, both forms of hedging protect you against the adverse market exposure that you are concerned about. So in the example I gave earlier, where you have a UK company buying an asset in the US, financing in pounds, paying dollars, you're worried about sterling depreciating against the dollar. On an unhedged basis, it means that the sterling you'd previously assumed would be sufficient to purchase the asset is no longer going to be sufficient. You've got to find more money to close the same deal without necessarily having an offsetting benefit. You may or may not. Generally speaking, though, if there is an offset, it has the potential to be a temporary offset as opposed to the increase of purchase price being a permanent effect. Secondly, both, and this is most important, both purchased options and deal contingent forms of hedging carry the benefit of a capped loss on the derivative in the unlikely event that the deal doesn't close. You can think of this in a way as a form of insurance against potentially a very adverse outcome, not necessarily from a probability standpoint, but the potential impact of a deal failing and having to unwind a committed hedge like a vanilla forward, for example, where the unwind, if the market has moved significantly, could have a very, very large negative mark to market. So in the case of a purchased option, you can never lose more than the premium that you've paid for it. So there's a known maximum cost. Obviously, with an option, you could sell it and potentially recoup some, all, even more than the premium that you originally paid. But the good news is there's a maximum loss at the level of the premium. From a deal contingent perspective, what are the common elements? You pay nothing up front. Unlike a purchased option where you have to pay that premium regardless of what happens to the M&A transaction, in deal contingent forms of hedging, you pay nothing up front. Secondly, if the underlying transaction, whether it's a divestiture or an acquisition, fails to close for any reason whatsoever, you walk away from that hedge having paid nothing for it. So unlike the purchased option where your max loss is the premium, whatever amount that is, for a deal contingent hedge, you walk away for zero cost. You've never paid anything up front, and you walk away having paid nothing for it. Those are the common elements of deal contingent hedges, as well as purchased options, and why they're considered best practice in the context of transactions where there are third-party conditions that are required to be met, and therefore somewhat unpredictable, in order for the underlying transaction to close and that market risk element that you have to manifest itself as an actual risk. So from a deal contingent perspective, we're talking about a hedge that is, by design, fit for purpose. It is hand in glove with the risk on the underlying M&A transaction. The M&A transaction goes through, you have a hedge. If the M&A transaction does not go through, you don't have a hedge and you walk away for zero cost. Coming back to the framework for a second, I'm just going to move to the next page briefly. And what you'll see here is how we quantify cost. I'm going to speed up a little bit, just given the time, how it's passing. But essentially, when we quantify and describe risk, the quantification uses tools that you'll be familiar with in terms of value at risk, or PFE. The graph that you see on the left-hand side of this page basically has a historical pricing chart for Eurodollar, as well as a forward-looking risk cone. We look in an M&A context at both sides of the risk cone. So one side represents the risk, the quantification of FX risk. Should you hedge via a vanilla forward, a committed form of hedging? So what's the risk there? The risk is if the underlying deal doesn't close, you have to unwind that vanilla forward. Presumably you don't need it anymore, and that can carry a potential cost. So we quantify that cost. The other side of the risk cone is basically to help you understand how much risk do you have on the transaction if you did nothing. Not every M&A transaction has a quantum of market risk that makes it material in the context of the company. So sometimes the market risk is so small that it's basically not worth the effort to think through a hedging strategy. In other cases, it's much larger, and we want to know that number to put it in context. So we look at both sides, and the table that you see on the bottom right of this slide basically shows different tenors, because M&A transactions also have some uncertainty around when they'll close. And it quantifies both the risk of using a vanilla forward if the deal doesn't close, and the risk of not hedging if the deal does close. And so that's the basic quantification we do to help our clients think through various alternatives. If I flip to the next page, what you'll see here is a deep dive a bit on deal contingent hedging. And so the attributes that I described earlier, nothing up front in terms of cost. You're protected against the adverse market movement you're concerned about. These are bespoke in that they are designed to match the M&A risk perfectly. We'll come to that in a few minutes. If the underlying deal doesn't close, you walk away for zero cost. I'll add another one, which is the potential for favorable hedge accounting associated with these transactions under IFRS 9. These attributes apply regardless of kind of what product we're talking about, whether it's FX product, a rates product, inflation, commodities, what have you. These are common attributes to deal contingent hedges. The context for a deal contingent hedge, we often have clients ask us, well, why would we use one? And my answer to the question, not to answer a question with another question, but it's useful to understand what the alternative is, what this particular client would normally do in an M&A context before considering deal contingent hedges. And I generally get one of three answers, which you'll see in the middle of this page. Sometimes clients would use a vanilla forward, a committed form of hedging. And again, we are agnostic as to what clients choose to do, but we do want to make sure that any form of hedging is suitable and appropriate for a client, and that they understand the risk that they're taking. In general, as we've mentioned, we do not consider vanilla forwards to be best practice for managing contingent market exposures, because the exposure is contingent and the use of and the form of hedging is not. And so we generally consider deal contingent forwards to be a safer, more conservative way of hedging a contingent market risk. The case is a little bit easier to make if clients use purchased options, historically speaking. Purchased options are a perfectly good way to hedge a contingent market exposure like an M&A transaction. They are best practice for sure. However, there are some benefits to deal contingent trades, particularly deal contingent forwards, which is why we are seeing a proliferation of their use. And the very simple reason we're seeing them used more than vanilla options is cost. The easiest way to think about this is if the premium associated with a purchased option costs 100 units, deal contingent forwards carry a deal contingent fee of somewhere in the range, let's say, of 25 to 50 units. More often than not, it's towards the lower end of that range. So somewhere between 25 and 50% of the cost of a vanilla option. So if you're spending somewhere between one quarter and one half the cost, that in and of itself is pretty compelling, especially in the context of a large deal where option premia can be pretty significant. If I can cut that down by a half or a third or a quarter, that's fairly compelling. Now, you give up something. With a purchased option, you can benefit fully, above or below your strike, from favorable market movements while being protected against adverse ones. You do not get that benefit with a deal contingent forward. So if your deal contingent forward has a deal contingent fee of 25% of the cost of a similarly struck at the money forward option, you're only going to pay a quarter as much as you would for that option, but you're going to lock in the exchange rate as opposed to with the option having the ability to benefit from favorable movements. That said, what we find after lots and lots of engagements with clients on lots and lots of M&A transactions is that the increased cost of purchased options relative to a deal contingent forward is generally high enough that the benefit associated with purchase options is generally viewed as not worth it. Most of the time, M&A transactions are announced at a time when market conditions are favorable enough to support the deal, including the level of interest rates, the exchange rate that is relevant. So if the deal works in the current environment, most people just don't find it worth it to pay 2 or 3 or 4 times as much for hedging costs simply in order to benefit from a favorable FX movement. It does happen from time to time, but more often than not, we see clients going for the more cost-effective alternative. So that's if clients use purchased options. We also have clients who just say, I'm going to wait. I'm not going to do anything until the underlying transaction is basically certain. And I'll wait until that last primary condition to close has been met, and then I'll enter into a vanilla forward. How does that sound? We say that sounds entirely reasonable. In your normal practice, you hedge certain exposures when they become certain. So you could certainly do that here. It's just that you may be taking months and months of market risk waiting for that key condition to close to be met. And so if you're going to do that, let's think about what is the incremental cost of a deal contingent hedge, which you can put on safely right at announcement. So that's going to cost something extra relative to waiting, most likely. But you're going to avoid months and months of market risk. So let's weigh these two alternatives. I can take the market risk and have lower hedging costs, or I can have slightly higher hedging costs, but hedge in a safe way from the time that the deal is announced. And so there's a balance, and there's no correct answer to the question, but we help clients do that analysis. So if I move on then, I'm just taking a look at the attributes for common forms of hedging on M&A transactions. You'll see on the right committed forms of hedging, and on the left uncommitted forms of hedging, including purchased options, deal contingent forwards, etc. The attributes are more qualitative in nature: protection against protection against negative mark-to-market if the deal fails to close, provides protection against an unfavorable FX movement, participation in a favorable FX movement, and hedging costs. So what you'll see here is the highlighted areas for deal contingent hedges. They stack up pretty well along these qualitative metrics. The one negative is for the deal contingent forward. Again, we've just alluded to this, the fact that it does not allow participation. But the evolution of deal contingent forward pricing and costs becoming much more favorable to clients allows it to be oftentimes the tool of choice relative to purchased options for the reasons that we've just gone through. They can cost anywhere from a quarter to 1/3 to 1/2 of the cost of purchased options. So they tend to tick a lot of boxes, which is why we're seeing them become much more favorable. If I flip then to the next page, I just want to go through a moment how deal contingent hedges are structured. So very, very briefly, they look like a combination of vanilla forwards for every potential date in the M&A timetable. So with the help of you and your counsel, we will define an earliest potential closing date, a latest potential closing date, and give you a known exchange rate for every date in between. And that exchange rate for every date in between is basically the vanilla forward, plus or minus a deal contingent charge, depending upon which direction you're trading, buying dollars or selling dollars versus pounds, for example. And so the deal contingent forward rate to any particular date is the vanilla forward rate adjusted for the deal contingent fee. So how does this work? Well, we show it on this page, where if you look on the bottom, we've got the near date. In this example, it's 3 months from hedge inception. The far date, which is 6 months from hedge inception. The first element of pricing is the vanilla forward rate, which you see in the next column. The next column is the deal contingent charge in pips. And then if you sum those across, you'll get to the deal contingent forward rate. So we price these on the basis of assuming that the deal is going to close. And so when we exchange one currency for another, by embedding in the deal contingent fee, we are effectively charging you that deal contingent charge that we talked about only in the case where the underlying deal settles. If the underlying deal does not settle because if the underlying deal does not close, then the FX transaction does not settle. Contractually, it only settles if the deal closes. And so the deal contingent fee that we're embedding into the conversion rate is only paid if there actually is a conversion, which there will only be if the deal closes. That's how we structure the hedge, basically to give you protection only in the event that you need it when the deal closes, and allow you to walk away having paid nothing if the deal doesn't close. I want to address in the coming pages briefly some of the other attributes that we find to be important. And we're going to start to get into a little bit around process and a little bit around recent innovation. So one of the innovations we've seen is just around conversion. I would say 7 times out of 10, the way that the market risk is executed on an event-driven transaction like a deal contingent hedge is based on full risk transfer pricing at the point of hedge inception in the full amount. That's generally the case. Clients want to get out of the risk generally as soon as they announce a deal. And because the exchange rate that is prevailing at the time supports the transaction, they just want to get rid of the exposure immediately and lock in that rate. However, we do have clients, or there are market environments, where the preference is to buy the relevant currency over time. And maybe this is the common approach that you take in your normal business to buying large amounts of currency. And so we want to afford you the opportunity to do that. And so some of the innovation that we've seen is just around market execution. So full risk transfer, again, being kind of the standard approach, execution of the market risk over time being another common approach. So where's the innovation? Well, the innovation comes in different strategies that give you some degree of either cost reduction or a known worst case rate. So if you choose to buy the currency over time, we can embed in a worst case rate. If upfront you are indifferent, let's say, between buying the currency over a period of 2 weeks, let's say a 10-day average, or buying the currency over 3 weeks, a 15-day average, if you're indifferent upfront, we can monetize that indifference by putting an early call into the structure, and you achieve value for that. So for example, you might get a worst case rate associated with the conversion. You get the better of the average or the worst case rate with the early call feature where you monetize that indifference. Or if you don't want a known worst case rate, we could potentially reduce your deal contingent charge, monetizing indifference. So this is an area where we find some clients to be interested, certainly not everybody. The other point is around market execution. Sometimes clients want to bifurcate market risk from the deal contingent pricing and basically optimize pricing on both. And we've led a number of transactions where clients choose to do that. And there are some important attributes that we can provide as a bank beyond pricing to give you certainty that both of those optimizations will work well. So we can provide a backstop, for example, on the deal contingent hedge if we're going to take the next couple of days to execute the market risk. You don't want something to happen as you're executing the market risk that causes the deal contingent appetite across your banks to fall away. So we can give you a backstop. And there are other sort of structural enhancements that our clients have found to be important in this context, something we can follow up on individually if you like. I'm going to move along then to the next page, which is hedge accounting. Just in the interest of time, I'm not going to go through this in detail. What I'll say is DB has commissioned a pretty extensive white paper with a Big Four accounting firm on the topic of hedge accounting for deal contingent transactions. It's a very good framework to help you think through how to have the conversation with your auditor. And we can make it available to you. Just reach out to me and be happy to provide it to you. Also, just want to touch on deal contingent timetable and the various work streams that are required. Generally speaking, we can get deal contingent hedges done from start to finish, from the time we hear about the underlying deal until we're ready to trade, coincident with an announcement or just after an announcement of the deal, within, say, 2 to 3 business days. It does vary a bit, but that's generally speaking how long it takes us to get ready from start to finish. We've executed about 200 deal contingent trades over the last 6 or 7 years, and about half of those are on deals where DB is not involved as either an M&A advisor or a financing provider. So in order for us to be relevant in the half of those cases where we don't have a role, we've had to be able to move very, very quickly to compete against the banks that are financing providers or M&A advisors. Our clients wouldn't ask us to participate if we couldn't move that quickly. So the main work streams are doing due diligence on the underlying transaction, pricing the transaction, documenting the transaction, and getting the necessary approvals, and we can do all that very, very quickly. I'm just going to touch on innovation, and basically a number of questions have been raised with respect to innovation. I'm just going to touch on some of them. Variable notional deals, where the size of your exposure varies by M&A outcome. We can underwrite that. Post-close hedging. So not just hedging a pre-close market risk, but also hedging a post-close market risk can be done on a deal contingent basis between signing and closing. Large notional execution, we've already touched on, bifurcating market risk and deal contingent pricing. ESG-linked derivatives, both in a vanilla and deal contingent context. Low probability transactions. Most deal contingent trades are done on deals which have a relatively high probability of closing. We can potentially do it on lower probability transactions like contract tenders. And then finally, SPAC mergers. And I see we have a question on this one. So the question is, how do you see the increased use of SPACs affecting M&A? One, I think it's both increasing the amount of M&A going on and it's cannibalizing other forms of M&A. There are some distinct risks on SPAC transactions. We've actually underwritten our first deal contingent hedge on a SPAC deal recently. So if you're thinking of selling assets to a SPAC and you're thinking about, most SPACs are US dollar denominated. And so if your use of proceeds is not in US dollars, you might think of maybe a contingent hedge or even a vanilla option, maybe the appropriate way to hedge that risk. The key thing is there are some clear distinctions. You generally don't have a lot of regulatory risk on these deals because you're merging with a blank check company. There's not a lot of increased market competition or a reduction in market competition as a result of the combination. But you do have some distinct risks. Usually, there is a minimum cash condition associated with the potential, at least, for SPAC shareholders to redeem their shares. That can cause the cash on the SPAC balance sheet to go down, which could impact either the ability of the deal to close or the amount of money that the target or the target shareholder will receive. That creates some variable notional concerns. It also is a slightly different approach to a shareholder vote that you see in a normal M&A context, although obviously related. I'm going to answer a few other questions. How does the counterparty bank hedge the risk of the deal contingent hedge? As in, how do they offset the risk of the deal not proceeding? There's no real way to hedge the M&A risk. Remember, I described up front that there's both M&A and market risk. The M&A risk, the only way to really manage it is in the context of a portfolio. And so much like an insurance company who can pass along pricing benefits when they develop a pool or a portfolio of deals, banks are able to do the same. For example, if you've got 2 clients, both of whom are selling pounds and buying dollars, if you believe that those 2 deals are largely uncorrelated, which we generally find they are, banks can cap the risk on both deals with a single hedge. Maybe they buy one option to cap the exposure, and that one option hedges both deals, both M&A transactions. And that's where the portfolio effect starts to show up. But generally, you can't hedge the M&A risk. You can hedge the market risk. I think we're running out of time. I've got about 9 or 8 seconds left. If you have other questions, please feel free to reach out to me directly. You have my email address. Thank you.